As you know, fixed interest has traditionally been a foundation for clients seeking to lower the volatility in a diversified portfolio. They find its defensive qualities, such as the potential for income generation and greater security for capital, compared with some other asset classes during times of market volatility, highly appealing. It's the reason high-quality fixed interest investments proved particularly popular during the latter stages of the GFC, when developed world interest rates were at extremely low levels. Issuers of fixed interest securities also took advantage of the low interest rates by locking in fixed interest investments over much longer periods. The need to have extremely low interest rates starts to abate as the economy strengthens. In these circumstances, interest rates generally begin to rise. This can cause bonds to drop in value, particularly those issued for longer periods of time. But for the smart advisor, changing conditions simply requires a change in thinking and an innovative new investment approach that straddles the fixed interest and short-term money markets. One, for example, that includes 90-day bank bills, fixed interest bonds with shorter maturity timeframes, or variable interest products like floating rate notes, where the rate of return is reset periodically. Such an approach might also utilise swap fixed interest derivative instruments, which manage fixed and variable interest rate strategies. Shorter maturity fixed interest, money market securities and derivative instruments tend to be less price sensitive to rising interest rates. Hence, they give portfolio managers greater flexibility in reacting to market changes. Using a benchmark like the UBS Bank Bill Index, rather than traditional fixed interest benchmarks like Barclays Global Aggregate Bond Index, also offers potential benefits such as a low-risk starting point, lower volatility, and greater flexibility to access money market instruments, as well as fixed interest assets. In short, it may offer your clients an attractive option that could assist in reducing the risk of capital losses during periods of rising interest rates, while focusing on the returns that fixed interest can generate. And while it's new thinking, this is actually a clever evolution of the traditional approach to fixed interest rather than a radical departure. Simply by focusing on portfolio duration and the benchmark used, it's enabling fixed interest to maintain a defensive role in a portfolio, irrespective of interest rate movements. No doubt you'll have questions, and we're ready to help. Basically though, fixed interest can continue to play a protective role in your clients' portfolios by taking a smarter approach than in the past. That's where the Advanced Defensive Yield Multi-Blend Fund comes in. It's more innovative because it invests in high-quality, shorter duration assets from leading institutions and corporations. It uses the UBS Bank Bill Index as its benchmark, which may offer greater flexibility and a lower risk starting point than traditional fixed interest benchmarks. This product may be suitable for investors looking to diversify their portfolios and could complement traditional portfolios as part of an allocation to fixed interest, especially as interest rates begin to rise. For further information, visit advance.com.au.